We're whipsawing a bit on the day, Seema, but in general, Nvidia, Intel, some of the chip stocks playing, well, a key part once again. Is this the ongoing narrative?
It certainly seems to be the case. It's funny because when we came into the year, the expectation that this would look very, very different to 2023, that you'd have a broader set of rallies, not just focus on those big tech companies. And then fast forward 6 months, and actually this year looks so much like 2023, where those mega caps are still carrying the market. I think the one slight difference, and which I think we're going to build on a narrative for the second half of the year, though, is that whereas the mega cap firms are still expected, we expect them to continue to do really well. We are expecting to see that risk appetite and earnings delivery broaden out beyond just those tech companies. So you see some other companies joining in with this positive news.
Seema, hey, it's Ed in San Francisco. So I'm just back from like a classic July 4th long weekend in the US where we sit around the table and people say, hey, have you seen Nvidia? Like, what's that thing about Nvidia? And then they bring up interest rates and then they brought up the election. But I think the fair thing to say is everyone was kind of asking in financial markets, what is the thing right now that's the main driver? Or is it a combination of all three?
Well, so I think, at the moment for equity markets in general, clearly the major driver is still that mega caps. Nvidia, the Mag 7, they continue to really be those major foundations for the equity market rally. At the same time, you are still seeing some kind of optimism feeding into the market with these expectations for Fed rate cuts, which we would certainly agree with. And then with the US election, that's adding volatility, but we don't think that volatility would be sustained for much beyond the election. So not something that we continue to be worried about.
Seema, go global, because we know you can, and that's why we love you. Look, UK just had elections. France, we're still trying to work it out. US, we have that anxiety. Is US the place to play for equities and indeed for bonds?
Yeah, so look, the election uncertainty that you've seen unfold in Europe has been somewhat damaging. I think when we think about Europe, investors for the first time in years, actually just about 3 months ago, started to get really interested in Europe again. Started to see some earnings delivery, some slight cyclical upturn, and had become interested. And then what you see now is that this political turmoil seems to unravel some of that optimism that had been feeding through. So now we're looking back to the US. Now, obviously, the US has its own election volatility on the rise in the last couple of weeks, and certainly we would expect that to continue through to November. But actually, when you look at over another, not just focusing on the next 6 months, but really taking more of a long-term perspective, that secular bull run that you see for the US, which is really built on these technology companies, we think that will still be sustained. So, of course, there's opportunities elsewhere. It always makes sense to diversify and try and get exposure to other markets. But actually, as a foundational element of a portfolio, we still think that the US is the one that really deserves the overweight.